Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. The ASX rebounded yesterday somewhat, stabilising after its plummet the day before, and the day before that for that matter. While it hasn't yet recovered all the ground lost, investors do appear to be jumping back in to buy the dip. So what are they buying, and where are those opportunities in the weeks and months ahead? Remember, this is general information only. You should always seek professional advice before making investment decisions. Sam Koch is a senior investment analyst at Wilson Asset Management with a focus on small to mid-cap stocks. Sam, welcome back to Fear and Greed.
Thanks for having me on, Sean.
Quite the week. What have you made of it so far? In fact, quite the last three sessions, really.
It's been quite historic, actually, to be honest. We haven't seen an 8.5% intraday swing in the S&P 500 for a long time, since COVID and GFC, really. So I think a lot of people are labelling this historic, and it's historic for a number of reasons. We've got VIX over 45, well over 45 as well.
So just the VIX being the volatility index?
Correct, the volatility index, and it highlights how uncertain the macro environment is at the moment.
Okay, and the local market here, have you seen these sorts of swings without having a pandemic or without having a global financial crisis? It's pretty amazing.
Yeah, you'd think Australia only copying a 10% tariff. We might be somewhat insulated from market movements globally, but to be honest, closer to home, Australia is sort of down 15% peak to trough. And the small industrials, which we focus on within the small to mid-cap funds, have fared even worse than that. So there's a lot of noise. The market's reacting first without really understanding the impacts. And there's a lot of volatility out there. But we're seeing opportunities. You know, our funds are focused in on the small cap industrials, and typically those are exposed to the domestic economy. Mm-hmm. And with all the volatility, we've actually seen rate cut expectations. So expectations of lower interest rates play out within Australia of the balance of calendar year 2025. So
and that helps some of those small caps you're talking about.
Exactly. Things could be looking a little bit better for the Aussie consumer.
Okay. Before we jump into any specifics, what broadly are you looking for among those small caps? What features do you like?
Yeah, we're looking for like a really strong management team, a strong balance sheet. We're looking for, earnings growth as well, typically driven by the top line. And our investment process is trying to identify undervalued growth companies with a catalyst. So it really needs to have a catalyst to change the market's perception of the business. Right here in the present, I would say that the fund has reasonably high cash levels, but also a lot of the exposures to domestic cyclicals. And we've been trying to position the portfolio that way for the better part of 3 months, to be honest. We've got a bunch of names in there like Judo Bank, AP Eagers, which is the largest car dealership in Australia, EVT, which operates cinemas and hotels. And a lot of these companies aren't exposed to tariffs and arguably could benefit from a better consumer in Australia.
I want to get into some of those in a moment. How important is management? I mean, when you gave me your category, it sounds like a very Jeff Wilson Asset Management style category to have, to be honest. But like right now, how important is management when you're in the midst of turmoil?
Oh, it's critical. At the end of the day, we're just analysts trying to analyze how a company's going and the trajectory of their earnings. At the end of the day, these management teams are navigating the volatility that they're seeing, whether it's in currency markets, whether it's, tariffs, you name it. It's a very dynamic business environment at the moment, and you have to have good management. So it's critical in small caps. Okay,
so let's jump into Judo Bank was the first one you mentioned a moment ago. Why Judo Bank? What's different about that one?
Yeah, it's fascinating. It's a challenger in the SME lending, business banking side of things. And it's rapidly been taking share from the major four banks. These guys ultimately will benefit as, the consumer and also business confidence in Australia improves over the course of the calendar year 2025 and into 2026 when we get those rate cuts that the market's expecting. So we can see that the bank will continue to grow its loan book well above market. Theoretically, the credit metrics are going to be getting better as well. And as they're rolling off from the old term TFF funding arrangement that they had a couple of years ago, you could get NIM expansion too. So we really like it. It's trading on 9 times price to earnings ratio. It's one of those where the small cap market doesn't have a lot of banks, and if they're looking at exposure and they're seeing CBA trade at close to 3 times book, then where can you get some undervalued growth in the small cap market? And that's a key pick for us.
And the catalyst in that instance is rates?
Catalyst is it's rates, but also it's earnings upgrades as the market isn't really expecting to the extent to which they can actually grow the loan book. Correct.
Stay with me, Sam. I want to talk to you about some of the other stocks and the broader outlook for small and mid caps in a moment. We'll be back in a minute. I'm speaking to Sam Koch from Wilson Asset Management. Okay, we were talking about judo. The next one, I think you said, was Eagers Automotive. Interesting company. It's got lots of dealerships, particularly along the East Coast. Am I right in saying that?
That's correct.
Yeah. Why? It's kind of an interesting one. It sort of had done quite well. Not that car sales are particularly strong at the moment. Why do you like Eagers?
Yeah, Eagers is fascinating, and we really like it for a number of reasons. As the scale player in Australia, it's the largest auto dealership in Australia. It's really highlighting how well they've benefited from that scale. Their their profit before tax margins are 3 times the like of their closest peers.
Wow. And
well ahead of the rest of the industry. And in some cases, the industry that is unlisted is actually loss-making. So, that's demonstrating the scale of their business. Secondly, they've got a really close relationship with BYD. BYD has been rapidly gaining share in Australia and overtaking the likes of Tesla. And we think that's a really strong partnership that could grow well into the future. And then lastly, as the scale operator, they have the opportunity to make a number of acquisitions, which could continue to increase that, but also potentially, given they're about 11% of the market here in Australia, they could potentially expand offshore as well. And their partnerships with the likes of Toyota and other OEMs would back them in doing that. So we really like it. It's owned by 30% by Nick Politis, and he's made shareholders a lot of money over the years. And it's trading at about 13 times PE, and the catalysts there are M&A and earnings upgrades. And for context, I think to finish on this point for AP Eagers, every 25 basis point rate cut in interest rates is about a 2% improvement in their bottom line.
Wow.
So if the market's right in saying that we're going to get another 4 interest rate cuts for the balance of calendar year 25, that's close to 10% earnings upgrade just by that alone.
And what's the risk? Every stock has risk associated with it. So AP Eagers, what's the concern?
The concern there is that the consumer might have a protracted downturn, that they might not be buying as many cars as they were a couple of years ago. And what in that case, what happens to sort of margins for the industry? I'd argue the industry margins at the moment are really at a tough point, at a trough. Half the industry is probably losing money. And so I think the OEMs, being the Toyotas and the like, need to support the car dealership industry and make it sustainable.
Okay, the third one, EVT, was that right? The cinema leisure operator?
Correct. Previously known as Event Group, EVT now. It owns Event Cinemas, a large hotel chain or a couple of hotel chains, and Thredbo for anyone that loves skiing. So EVT for a long time has sort of traded around about the value of its property. It has a market cap of about $2 billion, but it has $2 billion in net property assets on the balance sheet as well. So you're almost implying zero for the operating business. That's because the market's always been skeptical of cinema and the sustainability of hotel earnings in the context of Netflix and everything else that happens.
Yeah.
In February, for the first time in a while, they decided to divest one of their core assets, one of their property assets, and we can see the opportunity for them to slowly divest those property holdings and reinvest back into the hotel business at much higher margins. Again, it's a play on the Aussie consumer in a lot of respects, given the entertainment assets, Thredbo, hotels, cinemas, and should theoretically benefit in that environment too.
More broadly, just to finish up, small caps going forward, many have promised an outperformance of small caps probably for the last couple of years. It hasn't happened for all sorts of reasons. What do you think the prognosis is for small caps in the next 12, 24 months?
I think if people are looking for, certainty and the opportunity for earnings growth amongst the Aussie market, when you've got the likes of tariff uncertainty and currency volatility, then I think there's a lot to be said about, domestic exposure. And when you think about small cap industrials, the predominant exposure there is, to the domestic economy. So yes, small caps always get unfairly tarnished in times of volatility. Shoot first, ask questions later. But in this environment, I think they should mean revert a little bit quicker because of that opportunity there. So we're constructive on the outlook for small cap industrials, and just a piece on volatility in the market. Now, theoretically, if you're working and saving and you're building your net wealth, then lower equity prices, lower share prices are an opportunity rather than a risk. And so as long as people have done their homework, they're either backing active fund managers or thinking about the market more broadly, you want lower share prices rather than the opposite to take advantage of that. So I think, that's how we're thinking about things.
Sam, thank you for talking to Fear and Greed.
Thanks, Sean.
That's Sam Koch, Senior Investment Analyst at Wilson Asset Management. This is the Fear and Greed Business Interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.